mutual funds, ETF, index fund. All of these words, what do they actually mean and which one is the best to invest in? If you're new to this channel, my name is Nikki. I'm a certified financial planner and my goal is to help you crush your financial goals. So go ahead and subscribe so that you don't miss future videos. All right, let's unpack some investment vehicles, shall we? Let's start with a general explanation of all three of these terms so that we can dive into the details of each one. Mutual funds, ETFs, which are also known as exchange-traded funds, and the term index fund are all ways to describe a way to be able to buy a basket of stocks with just owning one single fund. So here's a visual. Imagine this box, and imagine that this box is full of a bunch of stocks. Got some Google stock here. Yes, we're gonna add that to cart. Facebook, yes, I'll take some Facebook. Microsoft, yes, add to cart. Apple, of course, gotta have some Apple in the portfolio, add to cart. Okay, so we have this box and a bunch of stocks in it now. We could end up having hundreds or even thousands of stocks in a fund depending on the actual goal of that fund. So instead of buying all of these stocks individually, we simply buy this one box. And just like that, boom, we're diversified within the stock market. So funds are convenient and they help us not put all of our eggs in one basket. All right, so now let's break down each of these major terms one by one and talk about some of the pros and cons of each. Let's start with a mutual fund. A mutual fund definitely has its pros and cons. One pro of a mutual fund is that it's a way to be diversified, of course. You can have mutual funds that are more actively managed, where a fund manager may be changing the stocks in the fund more often or trying to beat the overall market by stock picking. That's active management. There are also some more passively managed mutual funds now, where the fund is just tracking an index like the S&P 500 or the NASDAQ index. And this is what an index fund actually is, a fund tracking an index. But more on that later. So what are the cons of a mutual fund? Well, they often have investment minimums to be able to even own shares. Check this example out. This is a mutual fund that is focused on investing in stocks that have growing dividends. The ticker is VDIGX. And side note, let's talk about what a stock ticker actually is. A ticker is actually just a combination of letters, maybe even numbers, that represents that particular company on the stock exchange. So Apple's ticker, for example, Apple, $2 trillion company, very well-known company, their stock ticker is AAPL. So that's what a stock ticker is. It just identifies the particular fund or company on the stock exchange. So you can see here that this mutual fund has a $3,000 minimum to be able to invest in it. So that can really suck for smaller investors with smaller accounts. Maybe they don't have $3,000 to be able to invest right now. Another con of mutual funds can be the fees. Mutual funds have gotten better about this due to their cooler cousin, the ETF, bringing in competition. It also depends on which mutual fund provider you're working with. But there are a few different types of fees to look out for with mutual funds. Load fees, purchase fees, redemption fees, 12b-1 fees, and overall management fees are just the main ones to watch out for. These fees are usually broken down in something called a prospectus. The prospectus is the document that outlines all of the information about the fund for investors. Here's an example of what this could actually look like from a mutual fund that doesn't have most of these fees. This is VDIGX, which is Vanguard's Dividend Growth Mutual Fund. You can see that there is a $20 yearly fee if your account balance is under 10K, okay? There's also a management fee and a very small other expenses fee. So that gives you an idea of what these fees could look like for mutual funds. But this is Vanguard, and Vanguard has been known to do pretty well with competing with their fees. Here's another example of a mutual fund with higher fees than the Vanguard one. This is a snippet from the prospectus for the Fidelity Mutual Fund ticker FGRIX. This is a mutual fund that invests in stocks with an objective of both income and growth. You can see by this fee table that this mutual fund has management fees and other expenses fees as well. But they are both higher than the Vanguard fund. So how do you reconcile the different funds and fees? Look at the mutual fund's objective. What is it specifically invested in, and how has it performed in comparison to similar funds? Kind of like I compared Vanguard to Fidelity funds. Are the fees worth it? If the performance has been solid and it has a good fund manager, the fees just might be worth it. You also may be able to get a similar fund elsewhere with lower costs. Another con with mutual funds would be that they're not as tax efficient if you're holding them in a taxable account. Retirement accounts like IRAs and 401ks are tax deferred, so this isn't an issue here. It's only with taxable accounts. Mutual funds can pay out dividends, but that's not what I'm talking about here. The dividends are pretty expected with many funds. The fund managers may sell stocks in the fund at any given time, and they may have capital gains that they have to distribute to all of the investors in the fund from selling those stocks, and you have to pay taxes on it. Yes, even if you haven't sold any of your shares, you may still get a capital gains distribution. So this may not be a big deal to you, but it might matter if you're trying to keep your income under certain limits, and a big capital gain distribution could affect you. The last con, which isn't a huge deal if you're a long-term investor, is that mutual funds only price once a day at the end of the day. So if you buy a mutual fund, you won't know the price until then. You shouldn't be trying to trade in and out of mutual funds often, so I don't really find this that big of a deal. If you're trading mutual funds every day, you may want to rethink your strategy. All right, so hopefully now you have a better understanding of the pros and cons of mutual funds. Let's move on to exchange traded funds, also known as ETFs, the cooler cousin of the mutual fund. Why? Well, ETFs are meant to be more passive investing vehicles. This means the objective of the fund isn't to beat the market and be actively trading. It's to either track an index or a certain sector in the market, and the holdings may not change very often. When holdings in a fund don't change often, we call this low turnover. ETFs are usually less expensive to own than mutual funds. They don't have minimums, they're tax efficient, and they trade throughout the day just like a regular stock for those of you who like to see what price you're actually buying things at right away. Vanguard actually has many mutual funds that are offered as ETFs as well. This is nice because you don't have to deal with the minimums like you would with a mutual fund, and it may have the exact same holdings and turnover, but you may be paying a few extra bucks for the mutual fund. So the main idea used to be that mutual funds were more actively managed and ETFs were more passively managed. But guess what? Nowadays, mutual funds have more passive offerings available now, and ETFs are starting to have actively managed offerings. Why can't they make this stuff easy and just stay in their lanes? But guess what? Even if ETFs start to have actively managed offerings, ETFs will still have the tax efficiency and flexibility that can make it win the battle. All right, we come to our last term, index fund. What is that? Well, I touched on this earlier, but an index fund is simply either a mutual fund or an ETF that invests in the same securities that are in a specific index. There are many different indices out there, but I'll talk about just a popular stock index. Fun fact, indices is the plural of index. The S&P 500 is the most popular stock index, and it tracks the largest 500 companies by market cap. So what an index fund manager would actually do is make a fund that has all of those same 500 stocks to track the S&P 500 index. This is really an easy way to simply be invested in the stock market and get the average market return. You're not trying to beat the market here, you're just trying to match the market returns. Index funds are very popular, and I think that they're a great way to invest. The fund providers usually make it pretty clear when a fund is tracking an index. Check it out. This is a Vanguard mutual fund search. And here's a search of ETFs provided by BlackRock, who is a top fund provider in the industry as well. You can see clearly the IVV ETF is tracking the S&P 500 index. They try to make that part pretty easy to understand. And actually, the rest of the ETFs you see in this list are also invested to track a specific type of index. There are many of them. Whew, that was a lot of stuff. I hope I've clarified what mutual funds, ETFs, and index funds are. Choosing which one you should use is dependent upon a few things. But in general, ETFs can be really hard to beat these days. But you may be in a retirement plan at work that only allows for one or the other, or maybe you get access to both. You have to think about your overall goals with the investment, the fees, and the performance of the fund over time. Think about if you're trying to have an investment strategy that's more actively managed, where you're trying to beat market returns, or if you want something more passive that's just trying to track market returns. That's it, Finance Fam. That's all I have for you today. I hope you found this video helpful. Please like it if you did, and share it with somebody you know that it may help. Don't forget to subscribe to the channel so you don't miss future videos. I'll see you next time.